A quiet market, a wait and see market, but possibly sleeping giant volatility around the corner. Join us on the show as we go through all the market dynamics at play, the upcoming events, and the winners and losers and hedge fund watch as always. Hope you enjoy. So we just need to go through volatility, volume, open interest, the general state of the market. So Harinder, just start us off.
For sure. So last week, we've seen flat prices being relatively unfazed by the major headlines that have been coming out, the US, Iran, the proposed, potential increase of barrels from OPEC. Taking a look at what's been happening in terms of the volatility volumes in OI specifically, if we take a look at volatility to start with the July Brent option expiry yesterday, we'll look at August. So looking at the implied volatility, and we can see on my screen the open interest at different strike levels. So these would be the prices that people would be buying and selling options, and the open interest reflects the number of contracts outstanding at different options of these strikes. So one thing that's particularly interesting for these are for August options, is the open interest in the $60 Brent put options. So if the prices in August were to start trending downwards, one thing we might see is the players who've sold these options, so sold the $60 strike Brent put options for August, they'd likely start selling and driving the price down further. So that's I guess you call that the delta hedging or potentially gamma hedging effect.
Yeah, so let me just quickly explain, because I think this is a really useful way of visualizing it. So you've got price right now around 64-ish in Brent.
Yep.
So then you've got, well, fine, people are trading, live, but then you've got a lot of option trading at key levels around that. So it's very useful to see where all the volume is accumulating at these different levels, because it kind of gives you an indication, roughly what people are expecting next. So it might be in this very tight range, like you said, and I guess we would summarize that as volatility kind of being lower. We talked about the fatigue in the market to headlines not really responding that well, but it's a little bit like this indicates how you have to be a little bit careful, right? Because as soon as you go into one of these key areas, it suddenly could get very exciting, because as soon as it hits one of these levels, as you said, the market makers who sold those options, they need to then now start managing those options, which is quite complicated and all that. But for options traders, they'll know obviously that there's a lot of delta hedging to be done. So basically more activity, and then you can this can kind of predict breakouts, right? Once you hit one of these key levels, it could go massively up or massively down. And I think quite clearly the main open interest is at 60. 60's been a hot level all year. And that's still a lot of open interest there. But the majority of the open interest now is actually stacked on the 90 calls, that's what you were going to say, right?
Yeah, exactly. So we think this might be more likely to be sort of opportunistic, taking advantage of volatility breakout, trying to capture the increase in premium that will come to the 90 strike, should there be a little bit of an increase in volatility. So the players that are holding these $90 call options, unlikely to really think they'll realize it's like more of a volatility play.
Yeah, I guess it's just indicating that, on the balance of probabilities, the market is expecting, if there is going to be a breakout, I guess more to the upside. And how would they justify that? This is probably more like the geopolitical situation, I guess.
Yeah, perhaps. But I suppose if we've been in quite a tight range as well for the last week or so, could it be the case that maybe these strike prices have just got quite cheap relative to what these guys maybe just think could happen, and it's actually just like Harinder said, opportunistically just kind of buying volatility because it's probably gotten a lot cheaper when we've been range bound. So
great point. It's also maybe an indication that there's been a lot of effort to sell the market down, right? A lot of CTA being short on a momentum basis, discretionary shorts, so much so that it's kind of fighting its way down and not really succeeding that well. So suddenly that makes the upside relatively cheap. That's kind of what you're saying. So yeah, that's very interesting. That's volatility, right?
That's volatility, yeah. So let's move now quickly on to the volumes. So it's been a relatively muted week. As we said before, the markets remained pretty unfazed in the face of the headlines that have been coming out pretty frequently. So we've seen a week-on-week decline in July Brent futures of 15%. Of course, July's now expired. So if we look at August, that has picked up by about 13% in Brent futures, but for the remaining exchange-traded futures, the volume has come down. And if we compare the overall week-on-week across the exchange-traded futures, we're down about 10% week-on-week to 16.7 million
and just
barrels.
a reminder, because we'll show this, the officials guys have like an official assessment of all contracts, right? So, there's multiple exchanges, China and Asia, and of course, ICE are very big in oil as well. And so you do need to look at have some kind of evaluation for everything, right? So we've done that work, and you're saying that's overall down.
Exactly, yeah. So if we look on my screen here, we can see a breakdown for each of the exchange traded futures. And really the point that we're trying to underscore here is it's a fairly quiet end to the week, or quiet kind of week transition. And then if we look to the daily volumes themselves, this is now looking at the daily rolling M2 Brent futures. You can see over the last week, I mean, volumes have been pretty muted. There hasn't been that much risk deployed. And as we'll see later, the CTAs have pretty much remained neutral week on week, which you would expect with pretty range bound prices.
So we were saying last week, a market getting tired, kind of feels been a week or so tired, maybe slightly a dragon appearing somewhere, being woken up, maybe, but still a bit tired. Yes. And open interest, I guess an indication of that volume, how much of it is actual risk on? How is open interest doing?
Yeah, so let's take a look. So this is rolling M2 for Brent again. So in terms of open interest, I mean,
it's also declined, right?
Really, yeah, it really has. So that we're looking at the top there, that orange line is the 5-year max, and lately we're pretty well below it. For reference, for the latest 5-year max, that's 2024 when it was the highest. So yeah, we're almost half of levels that we've seen there. So really, yeah, pretty risk off market there.
Yeah, okay, good. So how do we summarize that? Tired,
sort of very like temperate at best.
So if you're a risk manager, and I guess this is the important bit, we're all risk managers if we're trading, and I guess from what we're gauging here, it's a market that's risk off, which makes it kind of the position size and can slightly increase because the volatility you're expecting is not huge. Therefore, you can start to put on a bit more volume, but at the same time, is there something around the corner? We've got the OPEC meeting coming up. Is there volatility around the corner? Could you be getting into like a bit of a false narrative of a low volatility environment? As a risk manager, you'd probably say more towards starting to be a bit more risk on.
Yeah, could be. I suppose one question I'd have is if there's like a sort of perceived slightly drying up of liquidity, would that affect your position sizing as well?
That's a good point.
It'll almost like kind of counter the sort of lower volatility.
Yeah.
But I guess, I don't know, I mean, I guess what time of year is it? We're about to go into June.
Usually quite an exciting time, the summer, peak summer demand.
Like things can happen in the summer.
Yeah.
A lot of these like kind of summer like plays or summer like positions kind of start pricing. So on the one hand, like people traditionally think of summer as being like, you know, kind of quiet lull period, but Q3 in the oil markets is traditionally quite, quite exciting sometimes.
So I'd be looking for, if traders can express, you know, high conviction trades in a low volatility environment, demonstrate a trend, they should be increasing the size on that, I would say. But if you're looking for an outright position, it's actually quite a dangerous time, funnily enough. So kind of middle of the range, maybe slightly lower than the middle of the range with Scott.
Yeah.
Okay. All right. So now let's go to what's driving the market. This is the herd mentality. Well, I guess we just said it, right? It's a bit of a tired market, so nothing really driving the herd. I think we got some images of like a sleeping bull or whatever.
The herd is quite tired, yeah.
And we just have to emphasize that again. I mean, last week we had quite a serious bullish headline, quite a very serious bearish headline, and both times we failed to break out of this kind of 64 to 66 range, and that says it all, really. I mean.
Yeah. Absolutely. I mean, so if we can go into a few of the headlines themselves, the US-Iran fifth round of talks, Iran saying they won't cease their uranium enrichment, market doesn't care, OPEC saying they're meeting on 31st, I mean, and there could be 411,000 barrels markets, kind of like we've seen this already a bunch of times.
Yeah, but we have that classic thing that I think the market's getting used to, which is we're looking at the herd mentality was very much about Iran. And then we know the Iran talks are going around behind the scenes, and we get little snippets coming through. And the way to read those snippets are aggravation or defensive comments either side. So we've had Trump basically say, these guys better sort themselves out, otherwise I'm going to sanction the crap out of them even more than I did before, and you know what I'm like. And on the flip side, Iran has said, I don't see this going anywhere. And so there's that, so which kind of demonstrates obviously that it's not progressing, but at the same time, we know it's still going on and we're still waiting. So it's wait and see mode type thing mentality.
Which feels like with Iran has been for like the past few years.
But that's it. So once the market says, well, I was focusing on that, and now it's just tired. Like
how long do you want me to watch this for before like something happens?
But then it's worrying, because if you then go, okay, let's just ignore it, then all of a sudden something significant does happen again, and then it's a big blowout, right? And I guess that's still on the cards. But what would shock the market? I mean, I guess if a deal was made, would probably be the most shocking thing, and that's probably risk to the downside.
I was going to say, like, it's sort of headline fatigue. It kind of implies that people don't think something's going to happen. It's like, yeah, all right, mate, like, just call me when you actually do something. Yeah. But then if something does happen, like you say, or if OPEC kind of like drastically change what everyone's kind of expecting them to do, it's almost like people it's so well telegraphed now that it kind of gets priced in quite quickly. And
then moving on to the OPEC, like you said, Harinder, like that's a meeting actually today, is it? There's a discussion.
Yeah, there'll be an online meeting and then they'll finalize it on the 31st, which will be, I think,
which is a bit of a weird approach. I think they're kind of setting themselves up to give some headlines into the market from today, Wednesday, until Saturday, feed it in, see how the market reacts, and then announce it on Saturday. But I think, as we just said, the market's going to be a bit shrug it off, I would have thought, no matter what's released.
Maybe for the viewers. So what would be the difference between the meeting today and the meeting on later in the week? Sorry, you say Friday?
Saturday. Yes, that'll be Saturday.
So
Saturday.
What would be the key differences in these two meetings?
Yeah, so I mean, today, as you mentioned, Greg, there might be a few sort of headlines that emerge from it, trying to test the waters, see how prices react, how the market reacts, and then Saturday there'll be the concrete sort of breakdown. Like I think they might discuss various countries' overproduction levels, what the compensation schedule, that sort of thing, and then potentially, the number that's been touted is the 411,000 barrel per day voluntary cut, putting back into the market. So yeah, I mean, it's kind of as one might say, it's a bit of smoke and mirrors sometimes. I put this at the front, say we're having a short meeting to, we're not going to discuss the real numbers, but in reality, they're probably already decided.
So in summary, I guess you've got to keep looking at these things, OPEC and Iran. Those still are the main two things, but not expecting a huge thing until there really is a concrete headline. That's all we can really say. Anything else macro related? Nothing really too interesting going on there either, really. I mean, we've not heard much for a while.
Yeah, there was Trump was talking about levying tariffs against the EU, and then he postponed that until the 9th of July to extend trade talks. So it's his usual sort of rhetoric where he comes out bold and then sort of retracts it and kind of goes.
Same with Apple, right? It's like he actually sort of singled out Apple and said, if it's like a 25% tariff if you don't start making iPhones in America.
But it's not shocking anymore, so.
No.
All right, wait and see.
Yeah.
Okay, so let's move now to how the hedge funds are getting on, and this is the Hedge Fund Watch. So yeah, I guess hedge funds being the majority of the discretionary and kind of fast money, I would say. They're reacting most sensitively to headlines. They move around their positions very rapidly. So they're always a good indication of the herd mentality feeding into real positioning. And I guess more of the same. Hedge funds have not been reacting too much, I would say, with CTAs, positioning is all kind of relatively the same, right?
Exactly, yeah. So if we maybe start with the money managers' positions. So this is CFTC data in Brent futures. So they added a little bit. They added 18 million barrels, 7%.
This is on the screen? Or?
So I have this, so the CTAs will go through on the screen. Yeah. This is kind of the position. This is the CTAs for Brent that we'll come to in a second. But just going through the money managers overall, there was a 7% increase in long positions, and then I think about a 10% increase in short positions. Net positioning around 152 million barrels, highest since 1st of April. So there is a decent amount of net positioning, but I think week on week the movements have been fairly insignificant. I think CTAs underscore the point that the last week we've seen relatively range-bound price movements, not really any decision, with the fact that they've remained pretty much static week on week. I think in WTI they kind of reduced their net length by about 600 lots, but given there's no real trend, there's no clear movement in either direction, CTAs have sort of remained kind of neutral in the face of what's been
the only thing I wanted to maintain our dialogue on was just that, do you remember when we said the CTAs have been generally short this year after that initial move down and kind of momentum trading down, and they've cut positions as the market's kind of stabilized and maybe come back up from its lows, and we said if it stayed in this kind of range bound price range, then we would expect the positioning to increasingly buy back their shorts because of the momentum essentially slowing down. Not really seen the indications of that yet.
I think there's still room to go. I think, like you said, like the levels that we've seen here when they're up to like 20,000, 40,000 lots, there's still a decent level to go. And if we were to get up there, you'd expect prices to get well into the sort of the 60s, maybe low 70s. But there's just a lot of room left. And we really need to see some strong momentum in the bullish direction to have these CTAs.
And for what it's worth, hearsay with fund managers who are discretionary trading and the relationships we have, there's been no solid view either. I mean, it's not like someone's coming out being like, no, I really think we're going to hit 50 this year or what. I think it's very tame in line with the rest of the market. But are we hearing anything generally on fund performances? I mean, they've had quite a shaky year, and I guess it's always quite a hot topic.
Absolutely, yeah. So I think April was the Liberation Day tariffs. A lot of funds got burnt, but there are a few that actually did pretty well. So Brevin Howard, Rockos, Discovery. So Discovery up 6%, Rockos 4.7%, and then I think Brevin Howard also like up to around 5%. So
These are macro.
These are macro funds, yeah. And I think so. In terms of how they actually made the money, I was reading an article. So senior macro portfolio manager, sort of not one of these funds, was talking about how when there was the peak pessimism about Trump changing his mind, that's when they put on positions. That's how they profited big. I think Brevin Howard did particularly well on widening bond yields, the 10-year bond yields, after there was sort of the sort of potentially unsustainable U.S. government debt. The view that was there. So there was some of the funds that actually performed pretty well with the tariff-driven volatility.
Yeah, and I think what I'd add to that is they're not hedge funds, but Citadel Securities and Jane Street are the two powerhouse market makers in the macro world. They just released, huge quarterly earnings. So I think that would make sense. They like volatility that has been this year, certainly in the first quarter, and they're probably ticking along quite nicely. And I think it was Jane Street expecting around 7 billion in a quarter, and I forget Citadel's, but 3-4 billion as well. So that's probably in line with what you expect. The market active and looking to trade, and some previous volatility, the market making firms should tick along quite nicely. It's not like a dead market is what I'm trying to say. Okay, great. So now let's move to our section about refiners. This is the Crack Spread Chronicles. Okay, so more of the industry side of things. I think we've got a bit more information this week than we have previously, which is good, kind of headline stuff. Do you want to take it away there?
For sure. So with the Dangote refinery in Nigeria, which is a big producer of gasoline, they've bought about up to 9 million barrels of WTI Midland crude for June delivery. Vitol has been the main seller to them, selling 2 million barrel shipments. I think we'll get the officials in shortly as well to kind of talk through what's been happening in the North Sea there as well. So what that kind of tells us, so Dangote is kind of loading up on their crude, and they were having problems with their RFCC unit, the residue fluid catalytic cracking unit, which will take in sort of the heavier, more complex hydrocarbons, crack them into gasoline, propylene, your lighter, more premium ones. If that unit's now up and functioning, you're going to see a lot more gasoline produced from Dangote servicing Nigeria and other nearby regions. So the EBOB grade of gasoline from Europe will need to find another source. So you won't be able to send it to Dangote anymore because of the supply that will be available from the refinery. So there might be increased flow to the US Gulf Coast, and the dynamics that will affect that there. So that was one of the headlines.
That's really, really good, because I think we've got to talk about this a bit. Dangote Refinery is a huge refinery that's been on the cards for a while in terms of coming live. It properly is now live, and it's such a big structural shift for the market because it's in the middle of supplying gasoline in Africa, which was a great outlet for European gasoline traders, and it was a big thing. So this is where it might seem okay, it's just one refinery, but if it's strategically important to the way the benchmarks price, it's hugely important to oil prices around the world. So you've got a situation where for a long time that was the outlet, and when you got into Q3 summer, we generally see EBOB and RBOB, like the gasoline prices, do very, very well. But this is a big structural change. If that market did very well every year seasonally, because this was one of the biggest outlets, and then the US, and that's now gone because Dangote can supply itself basically. And if it's been buying the oil that it needs to supply gasoline and it's all up and running, then actually the dynamics at play could be quite different in Q3. And this might be one of the more structural changes year, if you like, for gasoline.
Yeah, for sure. Because you had a similar thing, if my memory serves me correctly, was it Q8 when they started the refinery, and it kind of changed the whole like VLSFO dynamics. Right. And then this was like touted as like the same thing with gasoline, like you say, because there was this structural short which the European traders could optimize into West Africa.
Which would then lead to high prices in EBOB, which then sets everything around the world. Right?
Yeah, so you're removing the outlet for those high prices, because I think that's kind of what they relied on, and how they were able to so confidently kind of, drive the market higher.
And maybe that's why, we were commenting how gasoline's been a performer steadily this year in Q3 contracts, towards the upside, and suddenly it started to level off a bit earlier, is kind of our view. Open interest de-risked, and maybe that's directly linked to this for all we know. But I think to follow that up on the crude side, we're saying it's strategically important to have this gasoline outlet in Africa that's now gone. Well, on the flip side, you've got an outlet for crude.
Yeah.
So Vitol supplying WTI Midland into huge 9 million barrels. That allows, I think you said, like VLCCs with 2 million barrel huge cargoes at one time, sent over from the North Sea. So WTI Midland could have come from the US, but I think what's likely happened is it's been bought basis loading in Europe, which prices North Sea. Vitol, who are very active in the pricing of North Sea, have used Dangote as a really attractive outlet to say, look, I'm going to buy the WTI Midland, that prices Brent, and I'm bullish, and it's going to cause an elevation in Brent prices, and my outlet's now going to be Dangote. So it's kind of moved from like gasoline to crude. And it could go away to explaining their activity lately, and I guess the physical differentials in the North Sea have been strong. The Brent spreads have been strong, although weakened recently. But in general, it's funny, that kind of dynamics kind of shifted. But and that's it in a summary. But anything else on refiners?
Yeah, so we've seen in the US, there's been a few PAD 5 outages in refineries. And the kind of other main news was the Repsol's Bilbao refinery in Spain with its FCC unit, which is Spain's largest FCC unit. It's restarting that unit and it's back online as well. I think the officials guys as well will talk a bit more on that and the North Sea dynamics. So that's kind of enough. That's enough from me from the on the Crack Spread Chronicles.
Well, yeah, but just to follow that on again is we have been in a high margin or spot refinery margin market. In other words, looking down the curve, or the market is indicating not too excited about the performance of products and people's demand, let's say. But in the prompt, it's all very healthy. And we've been commenting on it week in, week out, because that should lead to very increased utilization rates of refiners. People should be running hell for leather to produce these high value products. And weirdly enough, fuel just keeps performing, right? So the high sulfur fuel we keep mentioning is usually deeply negative to crude. And that's now not just positive, it's quite strongly positive. You've got like 4 all-time highs.
On the single cracks. And you actually there was a period in the week, maybe end of last week, where you actually had positive European cracks as well.
It's a huge deal.
Yeah, because those ones always, like the Singapore cracks are always going to be higher than the Europe. Well, not always, but 99% of the time those Singapore cracks should be higher.
Yeah.
And you actually had the Europe cracks, I think, went up to sort of like plus 30 or something.
Yeah, so the way into these margin prices revealing themselves is relatively hard to predict because they're products in isolation. And I think things like the fuel market has caught people by surprise this year. And, this talk about, there being a lot more demand for high sulfur fuel oil from shippers who can basically buy it, scrub it, and get rid of the sulfur and make it IMO compliant. Which has now competed with the very low sulfur market. But the thing is that once that market has caught everyone unawares, and now it's sustainably been so strong, it's that Nassim Taleb quote where he's never seen a supply glut not followed by a shortage, but he's seen he's never seen a supply shortage not followed by a supply glut, but he's seen a glut not followed by a shortage. So in other words, we've got to be expecting these very unusually high-priced levels in fuel relative to crude to eventually lead the refiners to say, we've just got to do everything we can to reposition our refiners to flood the market with fuel, because this is so much more economical to do so.
Yeah.
And therefore it does make sense. If you're trying to produce as much fuel as you can, then you're going to be producing more of the gasol with it and less of gasoline, etc. And the gasol cracks have been under pressure. I mean, that has been logical. As fuel has risen, the gasol market has been under pressure. Not huge, we're still quite high levels on a crack basis, but at least that's some logic. And to me, it's a bit of an indication that we are getting there. Refiners are starting to really take seriously these high-priced fuel markets, and probably pretty soon we're going to get more and more of an increase. And fast forward 3 months later, we might be seeing an absolutely destructive fuel market, right? Like just supply everywhere. And people will have forgotten that 3 months prior, it's because everything was so high and the refiners locked that in and just went for it. And they can't just be like swing producers on a day-to-day basis. They're talking month by month basis. They're buying their crude and they're positioning it. It takes a while to filter into the market. And I'd say that's the summary of what's going on. So that is a little bit of a cautious state for the market coming into Q3. And I know that people or the traders generally like gasoline in summer, but actually more and more are liking fuel in summer. That's looking like a really dangerous market going forward, right?
Yeah. But you're right. It's like increasingly more of the kind of like talked about Q3 trades, fuel and VLSFO. But yeah, it's like you say, it's fuel is one of those markets where there's so much volume in the derivatives that once there's a trend, it can really move because there's so much open interest in the paper.
Yeah.
That when you know, especially if you've got like levels which are so high, if all of a sudden it looks like there's a trend to be ridden down, like just the sheer volume that's in that market can can really move it. And
it can. But what I would say is it's very interesting to me because I'm always excited. We keep saying it should eventually pop, but if it doesn't, we need to talk about that. If fuel stays strong the entire year, as strong as it is, that has to lead to a real shift in crude dynamics. Now, we've been calling for Brent-Dubai being widening, right? Brent getting higher over Dubai. And for the intents and purposes of this discussion, that's a good proxy for lighter gasoline crudes versus fuel-driven supplying crudes in Dubai. But it's the inverse of what we're saying, because if fuel stays really strong and the OPEC supply is not really making a huge difference, even though it's increasing, then really that Brent-Dubai should be under a bit of pressure. But it doesn't look that way. Brent-Dubai keeps rallying. OPEC keeps signaling they're going to increase more heavy supply, and yet fuel keeps rallying. So something's got to give here. And I think logic for me is it has to continue. Brent-Dubai has to keep widening because of OPEC. And that's just a macro thing to say. But until you see the fuel burst, it's actually not.
Yeah, it's really bizarre because you think as well, like a lot of like refinery upgrades and everything was, people don't want to produce fuel because it's a low value product. So you're almost sort of like disincentivizing anyone to try and like optimize. Well,
for the lighter product,
they're not justifying the cost of upgrading a refinery.
Oh, I see.
It's hard to justify because now you're like, well, if we produce fuel, we kind of still make money.
Yeah. And it's that classic thing that European refiners are meant to be the weaker refiners because they can't produce as much high value products that, all the Middle East refiners that have been set up in the last 10 years or even 5 years are all geared towards making more gas oil and running heavy crude. But all of a sudden it's like, well, actually the European refiners are kind of in a position, they're producing gasoline and heavy fuel oil. That's actually perfect right now. So it's a weird dynamic. And I guess that's why refining margins are so stubbornly strong.
Yeah, bizarre. You sort of want a refinery from like 25 years ago. Yeah. Like the old Russian refineries that just used to kick out fuel oil for the tanks.
But isn't that ideal thing to say? Is the missing piece not Russia? Because the Russia fuel that was so staple in its supply to the Mediterranean,
it's true actually,
is going in different places, and yes, fine, making its way back. And we have got a price cap that allows Russian flows to flood, but it's still redirected. It's not a question of fuel used to so directly impact Med. I don't think that's the case. And maybe that's exactly what's going on. And that needs to change. So maybe for fuel markets, what they really need to see, if the market's going to correct into like more normalcy, is a ceasefire deal. And refiners being able to produce back into Europe. But then Europe are very clear saying, we want bans. We don't ever want Russia oil again. But again, this is signaling from politicians, and economics probably does always win. But that's quite a lot of niche stuff there, but really important, I'd say.
Yeah, I'm like not really thought about it too much, but the sort of Russian fuel oil point, because that was an enormous
structural thing. Like that would price a lot of the barges, would affect a lot of the barges pricing. Was the kind of volumes coming from Russia and Lukoil, who managed a lot of that flow, were very influential in kind of the direction of that European market. The setting of the European benchmark.
Setting of the European benchmark. So it's a good point. You kind of take that away and. Yeah.
So we've talked about the what do we call it? Normalization, those trades this year. That's definitely yet to renormalize, if you like.
Yeah.
Okay, seeing as we're talking about the physical and its nuances, let's go to the officials guys to get a bit more of a summary of what's going on in spot pricing. Hi guys.
Hello. So we'll talk a bit about the North Sea and Dubai spot markets, what's been going on there. So as you've been discussing, Dangote has recently restarted their RFCC, and we've also had another a bit of a batch of refineries come back online in Europe, such as the Bilbao refinery as well. This is probably helping some of that glut in Midland cargoes that was weighing on the North Sea physical clear into Europe and into WAF in this case. So that we've seen Vitol, who were bidding up June BFOE all through March. They recently sold 3 Midland VLCCs to Dangote. Most recently, they chartered the Marshall Island flagged VLCC Caspar which is currently en route to Lekki, Nigeria, laden with WTI. Having departed from Corpus Christi on the 27th of May, it's set to land in Nigeria on the 10th of June. So bypassing the North Sea complex, really. And this is just another example of a cargo that's setting the North Sea, or at least playing a role in setting the North Sea benchmark, but never actually landing there. So that's quite interesting. And in the window earlier in May, we saw the physical diff get really quite crushed down to like below minus 40 cents. But since then, the fizz has rebounded and now back in positive territory. Yesterday, it was set at about 14.5 cents above dated, about plus 14.5 cents, sorry. The small contango developed that did develop at the front of the CFD curve it seems to have been flushed out a little bit. So now the curve is looking more normalized and backwardated again. But we are still seeing kind of a bit of a recurring theme of a lot of Midland getting offered into the window. So yesterday we saw Exxon, Repsol, Shell, BP and Phillips all offering the grade, which moderate the physical diff a little bit from like clear of 20 cents to around 15. So yeah, it's been pretty volatile in the North Sea, and there has been a difficulty placing those Midland cargoes, but perhaps with the refinery maintenance kind of subsiding, they should clear more easily, and we should see a bit more strength in the prompt re-emerge again. But I mean, Dubai has also been pretty interesting.
Yeah,
what would you say?
Yeah, so while you talked about the physical diff in the North Sea, that's been recovering somewhat from its significant weakness in recent weeks. The Dubai physical premium has been very choppy. I think that's largely a function of the window dynamics, because we've had for a long time now, last couple of months, PC, PetroChina, has been the only real buyer. So as soon as PetroChina becomes quieter, the buy side is very, very sparse, and it's easy territory for the physical premium to fall off. And yeah, as like the mid-May, PetroChina has been the only buyer really collecting convergences. I think there have been 2 non-PetroChina convergences since the 16th of May. So it's really a one-man army on the buy side there. And yeah, there's the Murban problem in Dubai, which we're going to do a video on later in this week. So make sure you keep tuned for that. And it's really just we've seen quite a few convergences actually this month. We had 31 in total, but 21 Murban nominations. So it is
a disproportionately Murban.
Exactly.
It's also been interesting because it started the month, it was very much VTOL PC as it was in the 2 months prior. But that sell side has really diversified quite a lot as the month has evolved. We've seen TOTS are coming in, and that's when the other grades are starting to come out. So, VTOL clearly had a lot of Murban to they collected over the previous months. Total are now offering in they're now delivering back into the window. So it's interesting from that perspective.
Certainly. And to go back to the physical premium, on an average basis throughout May trading, we're currently about 44 cents below the average of April. And that's going to be pretty important for the upcoming OSPs, which will be coming out late next week. In recent OSPs, the Saudis have been, because the Saudis are the important ones really here, the Saudis have been relatively kind. So last month, for example, the structure implied that they could have a hike of around 25 cents, but they only raised by 20. So I think we can expect a similar, slightly kinder
45 to 50
rate.
cents.
Exactly. Slightly kinder OSP setting for next month, because particularly the rhetoric from the Saudis and from OPEC has been very much about stability and consistency. So I think at this point, they're unlikely to change tack, especially while they're reintroducing their voluntary cuts, which, as Harinder mentioned, there is another meeting for on Saturday. And I think the market, again, is expecting a 3 times monthly increase, so 411,000 barrel increase to the quota amount.
But again, this is likely going to be a paper on.
Yes, exactly. It's on. They'll write up an extra 400,000 barrels, but compensation cuts and reality,
especially given we're entering summer burn season as well, with so expensive. Burning crude is going to be the key there. So the 400 KBD unwind will probably just be material for the the fundamental balance.
Exactly.
I didn't expect.
Thanks, guys. Got a bit of a where's Wally situation going on. Your location keeps changing, but yeah. Thanks, guys. So now let's move to the industry makers and losers. Let's start with the makers in the gold rush. Okay, so starting with more, I guess, generic winners and losers. We've said it a few times already, market not really positioning either way really on outright prices and spreads, but what do we think? Kind of people have made money on probably nothing really.
Well, not a whole lot has moved really.
Yeah,
I mean, I guess if you were short volatility on Brent maybe, but yeah, I mean the net changes on the week since we last did this podcast has been not a lot, right? You got Brent spreads down a touch.
And that was probably where we had the most high conviction trading of the more generic contracts, right?
Yeah.
Brent time spreads, people generally long, I'd say. That was doing quite well and suddenly dipped as we get close to expiry. So yeah, as you say, not much going on there either.
No.
Okay, so I guess it's going to be more in the minutiae, right? More the oil swaps, the wider global oil contracts. So Harinder, what you got for us?
Yeah, so we have two contracts for the gold rush. The first is the 92 spread, the Sing 92 spread. So this is the Eastern gasoline structure we're looking at. So kind of March, April kind of time frame, kind of weak, kind of lagging a little bit. But the strength has picked up on the back of Chinese refinery fires and Indonesian tenders, so about 10 million barrels per month. So if we zoom in maybe a little bit into April and May, we can see that so this is the 10-day moving average. We've consistently rallied up. I mean, this is kind of like taking profit up, down. But the strength in Eastern gasoline has been really strong. If we take a look as well at...
Sorry, this is all on a time spread basis. Right?
Yes, this is the prompt spread.
Yeah, gasoline versus crude is what we were referencing before. That definitely hasn't done much, right? I mean, that's not been an exciting market, but that is the difference, looking at generic contracts versus more the wider set of contracts that are available now. And I think the time spread is a great indication of the more physical minutiae around the market, sometimes very related just to the benchmark area like Singapore, but sometimes more a proxy of the overall East. But the time spread rallying that strongly indicates like real physical, basically tightness in that local market, like undeniably, right? So close to pricing, it wouldn't be a bluff. Or wouldn't be a financial thing. This is trade houses really taking this on, believing that there's something tight going on there, right?
Absolutely, yeah. And if we look at so if we take a look at counterparty positioning in the prompt Sing spread, in the 92 spread, we can see that majors have added quite a lot to their position. So in early kind of mid-May, majors
trade houses, right?
And trade houses too, exactly. Yeah, it's trade houses. I think this could point to profit taking as well because they've added positions and then liquidated and then bought back again later, sort of buying into that rally.
So we've seen the open interest and the trading volumes pick up quite a bit. You're looking at 10 or so million barrel increases at least, exactly. Right?
Yeah. Exactly.
And I guess the movement in the spread in the last couple of weeks has been what? Or last week?
I mean, we've been picking up pretty quickly, pretty aggressively. So over just the last week, we rallied about 50 cents. 50 cents
on a barrel basis.
Yeah.
Yeah, so we're looking at industry kind of revenues like 5 million plus. Pretty much makes sense. Not going to make their year necessarily, but it's a decent.
Like across the majors and trade houses, if there's kind of like a bit of a wall of buying, you'd expect the positioning to be at least 10 million barrels, easily. And
dragging the other spreads with it. There's probably some length there. So a decent bit of money being made, I would say, in the industry on that one. So that's a good summary. Yeah. Anything else?
Yeah, so the other contract we have is a Sing 380 crack. I mean, you mentioned it already. Fuel has been, sort of on a really, really powerful upward move. As in, we crossed obviously
the
positive.
chart, yeah. Okay.
Yeah, we take a look at the chart here. So this is the Sing 380 crack. 30-day moving average has been really good support. Now the moving average crossover divergence, the MACD, has gone negative. So I think the signal line has crossed below the MACD line. So this kind of might point to profit taking as well. So this rally's obviously been really aggressive, and now we've got this little sell-off. If we take a look at positioning, that kind of
so just before you do, just to this off, this to me indicates a proper bull market, right? So in a proper bull market, in my definition, I guess, is you get a majority long market against hedges that are passive, that just don't care, right? So if it's a kind of long only market, then as it starts to get into more saturation because the selling flows kind of disappeared or been absorbed, then you do get these rallies, but then there's too many people getting involved, a pause, and then you get these quite aggressive dips. So you've seen that a couple of times. One small one recently, but back a couple months prior, decent gap down. And this is what you would expect when suddenly people are realizing, well, not realizing, they want to take a bit of profit, or the market's slowed down, they go to sell, and there's no one to buy because everyone's already bought, so you get dips. But then the classic long-term bull trader who believes in this properly and wants to take it all the way to pricing, they're going to be looking to buy on dips. So it's funny, if you're going to trade a very liquid contract like Brent, any of the exchange traded futures, you can generally be quite malleable. In a trend, you buy as it starts performing, you kind of buy more, and you can be relatively like straightforward with that. But when you come to a smaller market, you kind of need to play the positioning, right? So if you wait for people to, and you want people to get involved in your position if you're long, they drag the prices up, but then they also start to profit take. So these fickle kind of fast money traders, you wait for them to cash out and move the market lower to re-enter. So you're buying on dips, right? That's a classic thing. If you really believe in the long-term trade, you buy in dips. And I think last week, we actually talked about our fuel traders saying, oh, it looks like, it might have actually consolidated. We've had a bit of rush of selling. Maybe it's looking a bit heavy here. Then all of a sudden, whack again. And I think that new rally, if you like, from the dip is always quite aggressive because an open interest has thinned out. So that when they come in and buy, the people that would have
sold,
or people who would have bought with you are not really there, or generally speaking, the participants aren't there. So these guys kind of take it forward quite aggressively, quite quickly, wait for people to rush in again, and the cycle repeats. And I think that's kind of what's going on. But yeah, sorry, you were saying?
Exactly. Yeah, I think just had a point on the open interest there. So if we look at this is the 380 crack, we can see we're well in the danger zone, well above historical max levels in the 380 crack. And also the kind of in the last few days that we can see the open interest has started to come off a little bit, which points to profit taking. So
Jeez, I didn't realize it was so. This is on the Sing one. Yeah.
Sing,
so we've mentioned this before, but it's unusual for the market to be so concentrated in the Singapore contract for fuel. It's usually the majority of the liquidity is in Europe. So for it to be 3 times the 5-year average is definitely standout, but it's also got to be weighed against the fact that are the absolute levels that can like that different to what you would have usually got in Europe. It's almost like the European open interest has moved more towards Sing for this.
And it's, again, we talked about it before with the MOPJ as well, is that
in NAPFA,
the market, as it kind of matures, the Eastern market was always traditionally quite focused on trading flat price. So they would have expressed a lot of speculative views by trading flat price. Whereas now it feels like more and more they trade the cracks because they see it as a more like reliable way to express a view.
More accurate, right? So actually going to relate to NAPFA fundamentals rather than Brent plus NAPFA.
Yeah, exactly. Whereas I remember when I was trading fuel, the 380 crack would trade like once a day. And it was always like, why are they trading 380 cracks? Right. And it was always a refiner who wanted to do a very specific volume, or a bank who was obviously washing out some flow, and it would be, everyone would always be like, oh my God, like, I think we talk about it in the morning meeting at our old shop, we'd be like, a 380 crack trading.
And things are becoming more Eastern focused in general as well, right? And the development of traders in the East is becoming more sophisticated. But we're looking at around 50 million barrels per day. Sorry, 50 million barrels open interest in the Sing 380 crack in the June, is it?
Exactly, in June,
So just have a quick look at June European fuel then and see how that compares in an open interest.
One of the first things you said to me when I was at our old job was I talked about 380 crack trading, and you went, that's the sort of stuff that gives our old boss a boner because it's proper fundamental trade.
Don't remember. It sounds like something I said. If you get the European open interest,
pull up the European crack open interest.
Yeah, there you go. So we're up towards 27 to 28. Yeah. So there you go. I mean, it's almost double what Sing is, and this is 20% higher. No, sorry, what am I talking about? It's 119% of 5-year average. So that means 20% higher.
20% higher, exactly.
So 20% higher is still indication that there's more risk on. And I guess then if you add, or if you bring back the Sing open interest, if you like, into the European pool, then you're way above risk levels, to be fair. You're into like 40 million barrels, which is way above the historical maximum. We've got all-time highs in fuel. It's definitely the most hot this market has ever been from a volume basis, from a level basis. Yeah. Pretty crazy.
Absolutely.
Okay.
Yeah, especially as when we went into 2020, high sulfur fuel was going to die. That was the kind of narrative, was that, the high sulfur. Yeah, no one's going to get a bone over high sulfur fuel anymore.
Yeah. What? Okay. So that's the winners. Now let's move to the market losing money. This is the Widowmaker.
Yeah, so the Widowmaker, we have the Singapore High 5, which is the differential between the Sing point 0.5 low sulfur fuel oil and the 380, which we were talking about before, high sulfur fuel oil contract. So really off the back of the 380 strength, what we saw sort of in the latter part of May, it's the inverse effectively in the high 5. So it's a small contract, but because it's the differential with the 380, when 380 is strong, the high 5 really collapses. And we've seen that with the move down from about $66 per metric ton all the way down to about 48. In terms of players in the market, so if we take a look at our COT dashboard for the high 5 on my screen here, we see that trade houses and majors were initially positioned long in the contract, and as we saw that massive 380 rally, 380 crack rally, that flow obviously caused the high 5 to collapse, and we saw them effectively stop out and flip their positions. So trade houses and majors were long, and then you can see trade houses flip their positions, and really, this is kind of a really important point that we were discussing earlier about liquidity pools and how bigger contracts can really influence the smaller niche ones.
Yeah, I think the differential game here, I've talked about it plenty of times, but it's worth revisiting. You have such an enormous rally or sell-off, but a lot of concentration in one big contract, like fuel oil versus Brent. And it gets so much euphoria, so much open interest. That's all anyone focuses on. So everyone just wants to get exposure to it. So it's a good signal that it's kind of gone too far, because now suddenly people are actually selling differentials that get you into the inverse leg, which is the crack. So if you sell high 5, that's the low sulfur over high sulfur. So you sell that differential to be long the high sulfur, which in any other market wouldn't make sense, because there's real physical implications from that, right? There's blending and there's economics going on there. But if people are just like, look, I don't care, I'm losing money on fuel, or I want to be long fuel and there's no liquidity to be buying, I'm going to sell that differential. But like you said, it's probably not that. It's people actually being long that because they were looking at it saying low versus high just doesn't look right. It's too low, and maybe that's changed something in the physical world. So they buy it independently. But you've got to remember that everything is so linked mathematically before it gets to pricing and relates to physical. So you can get stopped out, which clearly is what's happened, just because people, the momentum with 380 or fuel in general is just too strong. But we've seen this like endless amount of times, and it is a great indication of something like serious going on. When I was trading distillates like years ago, it was about the regrade. I remember it was the gasoil-fuel actually. So the Singapore gasoil market was just weakening every day. Like you could not get a bid. So the only way people were getting exposure was by buying the regrade. So buying jet fuel versus distillates, which is usually a very significant physical indication, right? It's jet over distillates, and refiners will look at that differential and adjust their yielding, and blenders will just adjust things in order to produce jet over distillates. But the market didn't care. It was like, we just got to buy the regrade. It went to all-time highs because it was the only way to get short gasoil. So that does happen. It's happened with the gasoline versus naphtha many times. And it's very frustrating, I think, for the traders who are looking at the differential as a hedge for their blending or their hedge for something on the physical. And suddenly it just keeps going way beyond kind of what would be considered fair value on a physical basis, or something that makes sense on a physical basis. And they've got no option, therefore, but to stop out. But that's kind of what you've got to be doing when you trade derivatives. You've got to look at the positioning as well. And having said all that, it is also an indication that, again, things are just getting too far with fuel, right? It's just knocking economics out.
Because I think that the with the high 5 spread, basically with your sort of hedges, the only guys hedging it really, I suppose, it's like a demand hedge, isn't it? Because you're switching demand between one fuel and another. Yeah. So
the number of participants and the volume that can actually trade that on that basis is very low.
And also fuel demand. Well, it's elastic, but it's usually not as elastic as like the supply dynamics. And there's a lot more going on than just demand with fuel. So you have hedgers who would be buying it, when it gets, I think with the high 5 spreads, it's always around sort of like $90 was like that's like the kind of scrubber spreads. There was like a range where it was like economical to run either or install a scrubber or run high sulfur fuel in a scrubber. But yeah.
And where are we now on the levels?
We're down 55.
I think with the Sing, it was always like triple digits was the kind of like usual levels.
Okay, so we're way below there, just highlighting how much things have changed.
And it's just, there's just, again, it's just like kind of decoupled markets, right? Like that you probably did have some hedging flow, but it was just dwarfed by just the outright speculative positioning, like anything.
Another thing I think, speaking to derivative dynamics, is that when you trade a differential, you have to think about conversions as well. So as you go up, so from fuel oil and you go to gas oil, go to naphtha, the conversion rate to convert crude per barrel into metric tons for products changes. So if you hold gasoline versus naphtha, or you hold low sulfur fuel versus gasol, which was a big one in 2022, there's actually a flat price component, because if you do say 100 kb, you buy 100 kb of, let's say, low sulfur, and you sell 100 kb of gasol, but actually there's more gasol per metric ton on a weighting basis. So you're actually short.
That's if you
flat price,
that's if you buy it on tons. If you buy if you buy it on a weight basis rather than volumetric,
well, that's what I'm saying. That's what you need to do. But this we're looking at it on a metric ton basis. So therefore, that differential is also an indication of flat price as well, basically. So not necessarily a thing here, but in the past, like 2022. The FOGO, as they call it, the low sulfur fuel oil versus gasol, that was very tightly linked for a time, and in a range, like you're saying.
Yeah.
And it completely blew out to the downside, because in 2022, a lot of the product interest was in gasol, and of course Brent, as everything was rallying, and it just took everything else by storm. So people were, the differential just completely depleted. But in addition, you also had a flat price component, and which got you, basically by selling differential, got you long flat price. So it's something that people need to be aware of if they're trading these things. You're like, this doesn't make sense on a physical basis, but have you also factored in the conversion? So a delta hedged metric ton thing, like you say, would probably make more sense, but probably even on that basis, it's quite low. But anyway, very, very interesting. So you think people have been caught out on that, essentially? Probably not huge losses, because not huge open interest in that differential, but
yeah.
A lot of it's probably been hedging, still valid, but I think there'll be like hedging volumes that would have just been kind of held on from probably like sort of high double digit numbers.
But it's worth mentioning that.
I mean, that's
It's just been trending down.
insane, right? And the top. You look on the screen, the top left of that chart is like $170 a ton.
Yeah, it's crazy how far it's come in the past.
It is worth mentioning that in addition to what you're saying, Harry, that it's usually quite niche hedging for physical. But this is how the physical traders like to trade derivatives. They very much start with physical drives the paper. And, we've talked endlessly about, we kind of think it's the other way around now. And certainly in this this scenario, you could indicate that to be true. But the point is that when they see something open up on a differential basis, that then leads to a change in physical, they say, okay, the gasoline versus naphtha, or the high five or whatever it is now physically uneconomical at these levels, or economical at these levels to blend, or whatever it is. So they put the hedge on, but then they also say, but that doesn't make sense physically, so I should also speculate on that. And that tends to drive their speculative decisions. So you would bet that, yes, it might be hedging, but probably quite a few people speculate on the back of that as well. 100%. And then how they manage their hedging P&L versus their spec P&L, that's something very, I wouldn't say controversial, but they definitely blend those in physical trade houses. And you're not quite sure, is this going to a physical hedge, or is this going as a speculation? Their job's just to make money at the end of the day, and they're managing both. So if they've decided to go, no, I really believe in this on a paper basis as well, then the hedging losses become speculative losses in a way as well. Right? Okay, let's look forward now, and this is the crystal ball. Okay, so as always, this is looking at the generic contracts first. We've got Brent flat price, the front Brent spreads, EBOB crack, European gasoline crack, and the gas oil crack. So I guess starting with Brent, same old story throughout the episode about it being range bound, but we've got to pick something here, right? I think I would say, from what we've been talking about, something is about to move. I think I would say it's going to start trending one way or the other.
You think that has to at some point?
It doesn't have to, but I just think the way the market's positioning, it's been having a breather. I think OPEC, I know the officials guys are saying that the increase this time probably won't be material because of the voluntary stuff and all that, but they're indicating that they're going to do it every month. So I think as that becomes more material, actually next month's announcement will be even more significant. And maybe that's what the market's waiting for. Like, is this unstoppable now? Is this unwind going to keep happening? And if that's the case, well, look, it makes sense to be selling flat price. And if OPEC clearly aren't scared of flat price being lower, then there's nothing in the way.
Yeah, because I saw, I can't remember what exactly it was, but I saw like sort of in an article, a quote from one of them saying like, we have to think of demand, which to me kind of implies that that's them saying like, we're not afraid to increase production, basically. They're saying, we have to think of like rising demand, basically. We have to be able to meet rising demand, which is quite indicative of that, saying we're not afraid to just produce more, like regardless of what happens, basically.
Yeah, and we've talked about them having a lot more understanding of what's going on than we probably give them credit for. And I would point back to the officials mentioned it briefly. In the pricing, Brent versus Dubai, it looks like Brent's massively outpacing Dubai, and that makes sense. But actually, if you look at the dynamics at play, what's actually setting the Dubai market is Murban crude. Now, Murban is like a high value crude. It's like a medium crude, but at the end of the day, it's not a dirty, heavy, like Al Shaheen fuel yielding crude that's setting the curve, because fuel's so strong. That crude's probably reasonably well sought after.
Yep.
It's the Murban that's more naphtha yielding. That is what's setting the Dubai benchmark. And that's caused a bit of controversy because it's, a higher value crude setting the market all the time. But it does show you that actually, maybe, as you say, OPEC are looking at it going, well, if you take Murban out of it, our crudes are actually doing pretty well. And there is demand. And they can set the OSPs high and clear the crude. You're probably right, actually, that is factoring in, and they have to meet that demand. That's not a bad point. But what does that mean for your flat price view, or involving sentiment as well?
I'm still bearish flat price.
Yeah.
I haven't seen anything to convince me otherwise in the week.
Harinder?
Yeah, I think I have the chart up here, so maybe you go through a bit of technicals. The 30-day moving average has been pretty strong resistance over the last few weeks. We also have this technical indicator, the Ichimoku cloud. Basically, the lower band of this cloud is a good metric for like where prices, the kind of midpoint of prices over the previous 26 days, and currently it's acting like a pretty strong resistance as well. So from a technical perspective, and on the MACD, there isn't really much in either direction, like momentum. I mean, that kind of makes sense because the last week has been pretty range bound. So I think, bearish as well from a more technical perspective. I just don't see for it to be bullish, there have to be something headline driven that's really strong to the upside
And sustainable, right?
And sustainable.
I guess it could surprise us. If there was going to be a surprise, I think we're in line with the general sentiment in the market, which means, something could happen that will catch a lot of people unawares, and maybe there would be quite a lot of scrambling, and CTAs are still short, and we know that they can flip and be very influential as well. So I wouldn't rule it out, but I guess, we're all saying
Bearish.
stats was bearish. And then the Brent time spread, I think, is an interesting one as well.
Yeah, so this is quite interesting from a technical perspective. So this kind of gives like the with the kind of converging down into one sort of level. It could be a volatility breakout one side or the other. So consolidation followed by a breakout in either direction. It's on the annotation there. So but I think as you said before, spreads have weakened a little bit, but they've been pretty strong for the last week. I mean, difficult to say in which direction, but I think there will be probably some.
This is going to be, expiry is going to be quite influential in this one, right? Because it's Brent expiry on Friday.
Less so than usual, because it's at a more reasonable level. I mean, if you rewind a couple months back, we were in $1 triple digits, right? $1.20, and the front spread, and that was indicating like genuine physical diffs on fire. The refinery margin's great, and we were kind of bullish on the back of it.
Yeah.
Now it's just volatility in the physical differentials. We've been negative, gone back positive. 50 cents on a time spread into expiry kind of seems reasonable where we are, and maybe the market is just effectively saying that this is reasonable. Nothing crazy is going to happen if I take these barrels and expiry at this level. I'm going to be relatively safe. You could have sell-offs on the OPEC news, but at the end of the day, as we said, people are probably expecting not to be a huge material difference with this increase coming up this week as expected.
I mean, like the only thing I was sort of thinking was that if, pretty bearish flat price, and if you get these OPEC headlines, maybe it gets dragged down with this thing. But so
no, we've always got to remember this is July. So this is July price
August.
crude. So July loading barrels is a while away. And if OPEC announced quite serious things, it has time to destroy that price as that Brent becomes real physical and starts to be more spot crude. Do you want to be holding the basket or whatever as all this flooding of supply? That's always a consideration. So fair enough.
I'll go bearish.
I'll go bearish as well then. Yeah.
All right, moving on to the gasoline crack. Again, we've mentioned it's slowed down. Something doesn't seem all rosy in gasoline. There's actually been quite a bit of bear talk here and there. But then again, we had the Singapore localized rally. So this could go either way as well. But I think looking at the chart will probably be quite useful.
Okay, yeah. So here we have on the screen the Arbor crack, the front Arbor crack. And we see that prices have been relatively range bound. In terms of the candlesticks, there might be a little bit more bearish conviction with the Maribozu candles, which are large bodied candles where the close is below the open. There is levels of support though that could come in and prove to be quite strong there, with the 100-day moving average kind of converging upwards to where prices are. That could be a level of support. And then the second level of support that's been sketched on here that we've seen through 2025. Again, it's likely that if prices were to trade down, they'd be supported at those levels. So, yeah, I mean, difficult to say which direction we think that prices will go.
I think we've got to bring in the news we were talking about earlier with refiners, right? I mean, if we think there's a lot of gasoline yielding and the Dangote refinery situation, it doesn't look like the market's scared of the supply. And actually, you were looking at the US gasoline crack there, not the Europe, but that's pretty high. I know the European tariffs would make a big difference because, if they're tariffed, then less gasoline will come from Europe. But it also looks like it could be supplied from other regions. And maybe that's why Singapore's been so supported, because it's kind of replacing the tariffed oil potential in Europe. There's more certainty bringing it from Asia than Europe. But it's given me the indication that the levels are relatively high. They're kind of comfortable. And the implied demand in the US, the signaling has been quite weak. Stocks are not in scary positions from a scarcity point of view. So I think it trends lower. I think that's where we're at.
Yeah, because last week we I think we went bullish last week, but since then you had that potential European tariffs, more chat around the Dangote stuff, and yeah, just.
So if you're concentrating on Europe, you'd be bearish, basically.
Yeah. I think for this week, bearish. Yeah.
Harinder?
Yeah. So if we pull up the EBOB crack as well here, actually, yeah. So it's
This is the European versus Brent. Yeah.
Exactly. Yeah. So if we zoom in a little bit as well. Yes, I mean over the week, kind of again pretty quiet. But as we said with the discussion we're having about Dangote, we would expect for those EBOB barrels to probably drive prices a little bit lower, and the crack would weaken. The EBOB crack would weaken. So if I had to pick a direction here, I'd be bearish.
Yeah, and you could also add, gasoline versus naphtha is an important dynamic, and naphtha has been dragged steadily lower as well, which probably helps weigh down gasoline. So all in all, yeah, all kind of points there. And then finally, I guess the diesel market. So the gasoil crack, what have you got here?
Yes, so we have the Singapore gasoil crack here. Again, it's pretty range bound, difficult to pick a direction. If we want to, from the technical perspective, there is a support here. So if we kind of look historically, this level of sort of like around the 1450 has been a level of support. So for it to really be bearish in the coming days and weeks, we'd have to see a breakout to the downside and a close below that level. Or a few consecutive closes below that level to really be bearish. So yeah, I think on this, from a technical perspective, it might be a bit more credence to the upside.
Okay. Yeah, I just think the theme of this year, I'm going to go off again the refinery side of things. Producing so much fuel, it's just completely like unstoppable, it seems. Then other things have to give way. Like we've seen the high five give way, low sulfur. Gasoil has generally been under pressure despite the low stocks in the US, despite a bit of short-term bullish sentiment there. And I think the more oil that comes online that allegedly we have on an oversupply basis, I think gasoil is the weakest part of the barrel, the most affected part of the barrel, because it's still relatively high levels. And I think there's nothing much to be said for it. So I think it's the one that goes. That's still my point of view. Like we talked about being bearish gasoil flat prices as opposed to Brent flat price, so you can get the gasoil kick as well.
Yeah,
that still holds true, right?
Yep, for me as well. I haven't seen anything to nothing kind of compelling to convince me otherwise.
Yeah, we've just got the chart here, don't we? This is a rolling gasoil future M1. That's I mean, it's in line with Brent from a large point of view, but it's definitely been trending lower, and it's nice to have that gasoil component in it as well.
Yep.
Because they're both, I know you're saying it's range bound, but it is longer term moving south, I would say. Yeah. So I'd be much more comfortable being long term bearish on that one. Okay, we'll leave it there. Thanks again, as always, for listening. Please like and share with anyone who might find it interesting. Be sure to check out onyxmarkets.co.uk if you want to get involved in these global oil markets. And as always, Flux.live has a lot of information for anyone and everyone to get more about what we're talking about. Thanks again, and see you again soon.